Hey everyone, Twilio stock is down 86% off its highs that were reached in 2021, and in this video I'm going to argue that the stock is undervalued at current prices. Of course, Twilio helps companies connect with its customers through several channels including chat and video. And so it's gaining adoption, but the big difficulty for Twilio is competition, as Microsoft and Amazon offer similar services in their cloud segment. So there are risks, but I'm going to argue that the rewards are worthwhile for taking the chance investing in Twilio stock. Let's take a closer look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so like I highlighted, Twilio stock is down 86% off its high, 85.91 to be precise. And today, on May 29th, I'm upgrading or I'm highlighting that Twilio stock is a buy at current valuations. Now, in its latest quarter, Twilio management said that they will, moving forward, continue to drive further leverage while also making focused investments that we expect will re-accelerate growth over time. In other words, trying to explain this jargon from management, what they're saying is our profit margins will continue expanding and we will accelerate revenue growth. Meaning if we were growing revenue, for instance, they grew revenue at 4% in the most recent quarter, in future quarters, we expect our revenue growth to be higher than 4%. So accelerating revenue growth, the second derivative, will increase. So that's good news for Twilio stock investors, because the main reason why the stock price is down as much as it is because of decelerating revenue growth and rising competition from powerhouses like Microsoft and Amazon. Still, the company had done a solid job in improving the business. The loss from operations came in at $43.5 million in the first quarter of 2024. That was an improvement from a loss of $264 million in the same quarter the prior year. So even though revenue only increased by 4%, the loss from operations decreased significantly. Twilio, like many other unprofitable tech stocks, really focused on profitability starting in mid to late 2022 when they noticed an increase in interest rates, a slowing of the macroeconomic growth, and so they decided to focus on profitability. Smartly so, and it's starting to pay off as you notice the improvement in loss from operations. Similarly, Twilio's cash flow from operations improved to $190 million in the quarter. Free cash flow improved to $177 million. That's up from $97.8 million for cash flow and negative $114 million for free cash flow, respectively. So the cash flow from operations, or CFO, was up to $190 million from $97.9 million, and free cash flow, or FCF, was up to $177 million from negative $114 million. Huge improvements in the critical financial metrics for Twilio. Still, investors were not impressed because these types of cost-cutting efforts can only really happen once or maybe twice in a company's trajectory. You can't continue cutting your way into increased profitability. Profit growth is most sustainable through revenue growth. And so that's where investors are concerned with Twilio. That's why the stock price is down so much. But given that metric, I think Twilio's management gave investors some key forecasts here. For one, they increased their active customers to 313,000, up from 300,000 in the same quarter last year. And the dollar-based net retention rate remained above 100%, which means existing customers are spending more with you this year than they did last year, even though the dollar-based net retention rate was down from 106% last year to 102% this year. This is one of those metrics. If I was paying an expensive valuation for the stock, I would raise this as a concern. I would raise this as a risk. I would be framing this in a negative view, right? I did that with Snowflake, if you saw that video. Snowflake's net dollar retention rate has been decreasing, but it's still well over 100%. But I presented that negatively because Snowflake is trading at a valuation that's 3 or 4 times as expensive as Twilio when measuring by the forward price to earnings. So if I'm paying that much higher a price, I want everything to be going in the right direction. But Twilio stock is trading at a forward price to earnings of just 16, a forward price to earnings of just 16. So I'm okay with some of the metrics not being perfect because I'm getting such a cheap price, if that makes sense, right? If you're getting a lower price, you're willing to accept some things that are not ideal because the price makes it worthwhile. If I'm paying a premium valuation, I want everything to be premium. And that's not the case with Twilio. We're getting a discount stock, and there are reasons why the stock is trading at a discount, right? So I highlighted that management expects its revenue growth to accelerate, and that's given in their 2024 guidance. They're forecasting revenue growth of 5 to 10%, which is 7.5% at the midpoint, which is faster than the revenue growth in the latest quarter. And then non-GAAP income from operations expected to come in between 585 and 635 million, which would be a solid improvement from the year before. So moving in the right direction here for Twilio. Revenue growth still not great for 2024, although it's getting better, much better, right? It was 4% in the first quarter, expected to go up to over 7% going forward. You remember the days Twilio was forecasting long-term revenue growth of over 20%. Those days are behind it, but the company can still grow at solid near or above double-digit growth rates, given the industry's overall growth, if Twilio can effectively fight for its market share with the giants. Sometimes smaller companies like Twilio can do better in a specific market, even against giants like Amazon and Microsoft, because they are more focused, right? Twilio, this is everything to them. This is everything for them. They have to win in this category. For Microsoft and Amazon, it's just one of the many products and services that they offer. So they're not paying close attention to what's happening as much as Twilio is paying attention. So they do have an opportunity to win. It's not a no-brainer that Microsoft and Amazon are going to eat Twilio's lunch and put it out of business. Although it is risky, you try to avoid that kind of competition, but Twilio's not at liberty to choose that at this point. Competition came and it needs to adjust, it needs to retaliate. And for investors, you're taking a chance here. You're taking a chance that Twilio loses significant market share and doesn't recover that market share. Okay, so you're taking a chance. That's why you're getting the stock at a cheaper valuation. So Twilio's management, according to their actions, seems like they also feel their stock is undervalued, as I do. They've bought back shares and they're reducing diluted share count. They used to have over 186 million shares outstanding. They've reduced that down to 181 million. So instead of diluting shareholders as they were previously, they're now buying back stock, reducing the share count, and that's going to improve profitability on the bottom line if or when they achieve profitability on the bottom line, because the net income will be split among fewer shares. So again, Twilio stock is down over 85%, close to 86%. It's now trading at a forward price to earnings of just 16. That's cheaper than a stock like Home Depot. It's trading at a valuation like the stock of Lowe's. So it's trading like these brick and mortar companies that are not growing revenue and profits or don't have expectations of strong revenue and profit growth. They're not a tech business. And so you're getting the stock at a cheap valuation, but remember, you're also taking higher than usual risk with Twilio. Still, overall, I think the risk versus reward is worthwhile, and I'm recommending Twilio stock as a buy at current valuations. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.